So good morning, everyone. Started about 1 hour late, but it's okay. So it gives me 5 minutes to talk, which is good. Anyway, let me tell you what an honor for me to be here today. I heard from some of my friends up here, there were some impressive speakers yesterday. So hopefully today my slides won't disappoint. But let me qualify, I have a disclaimer. I'm a banker, so I'm expected to be boring, although I'm trying to dress like one of you guys here. When I look back 20 years ago, when I was just born, when I started my career, I would never have imagined what all of us are experiencing today. This is, of course, thanks to the growing accessibility of the internet, especially here in Southeast Asia. The banking industry is probably the second oldest profession in the world, just behind another profession. I'm sure you know what it is. No, it's not politician. Anyway, it started around 2000 before Christ in Babylonia when merchants gave grain loans to farmers and traders. This was the start of the merchant bank. From then, banking evolved from pure lending to deposit taking, currency exchanging, to more sophisticated offerings such as option, futures, underwriting, and insurance. Today, the offerings have increased in both depth and breadth, but banking's bread and butter business of deposit taking and lending remains relatively unchanged. So the point I'm making here is that with technological advancement and the emergence of startup and fintech companies, in addition to the changing economic environment and evolving regulation governing banks, our playing field has done a 180 degrees change within just the last few years. In fact, let me share a quote by one of our advisors, Tan Sri Andrew Cheng. He gave a speech yesterday, and I quote him. He said, "Central bankers are taking away your lunch. Regulators are squeezing your lunch. Fintech is eating your lunch. And some of you bankers may still be out for lunch." So that was a speech he gave yesterday to all the bankers. Anyway, clearly business today is different. The way banks are run today is an outcome of over 4,000 years of history. After several cycles of growth and recessions, banks today are mostly large, stable, but very difficult to maneuver. So what do we do when the operating environment and our customer preferences are changing at lightning speed? Sorry, is it red or green button? Okay. So, ladies and gentlemen, let's have a look at what areas that I will be touching upon today. The first thing I would like to discuss is the rise of digital in banking, and for us to understand whether it's true disruptor or whether this is just a passing fad. So let's quickly run through some of the changes we are experiencing today. But first thing first, can I see a show of hands? How many of you have walked into a branch the past 1 week? 1, 2. Okay, I hope it's a CIMB branch. How many of you have carried out online transactions within the past 1 week? So every year, the number of tech-savvy customers increases. Today, there are more than 700 million digital banking customers across Asia, representing 16% of its population. And this number is growing at an exponential rate in line with internet accessibility. So digital banking adoption increased in tandem by over 200% in emerging Asia from 2011 to today. Correspondingly, we noted a decrease in the branch usage across the region. Moving forward, we will see a lot of migration from bricks to clicks, and we will need to reevaluate the overall business model as a result of digital. We need to reimagining our product offerings and how we target and serve our customers, our channel experience, and on transformation of our existing physical network. As you know, the expectation of customers are also changing in terms of how they interact with the banks. Instant gratification or instant decisioning is expected now. The new generation does not want the bank to dictate how they will be served. Instead, customers now are dictating how, when, and where they will want to engage with their bank. Let's take a moment and think about how we engage with banks these days. So I'm sure many of you, it has evolved over time. As we saw from my question just now, walking into a branch isn't the norm anymore. Instead, the platform of engagement has evolved to Skype, FaceTime, or chatting online with your banker. So in fact, let's try this. You just turn to the person next to you and ask them if they have a banking app on their mobile phone or tablet. Anyway, as you can see, all of you have the CIMB Clicks mobile app. And the future generation, and mind you, includes all of us in this room, want our banks to be in the palms of our hands. I mean, the entire process of banking from start to end is expected to be completed through our mobile phones or tablet. What we've also realized is that customers want products and services to be unbundled, and they demand more transparency in pricing and how they and the ability to switch costs for free. Customers today are educated, well-informed, and they will seek out products for the best value, and even if this means banking with numerous banks. So gone are the days where there is one preferred bank. Loyalty just doesn't exist anymore for the new generation. It's almost like speed dating for banks. No loyalty necessary. Anyway, one of the biggest threats is also the opportunities for banks, which is technological advancements and the emergence of fintech companies. They operate in a lower cost environment, lower capital environment, and they have technological advancements. I give you an example, P2P lending, robo-advisors, complete online banks, analytics, and big data. All of these things are forcing us to evaluate our business proposition to regain our competitive edge. The barriers to entry into the banking space are now eroded as fintech companies are generally not strictly regulated as banks. As a result of these changes, and as in an already very different economic climate, banks today are forced to shed costs and embrace technology. So I'll give you one case study, a very quick example, which is Alipay. Alipay is a third-party platform. Oops, wrong one. Okay. Sorry, this thing doesn't work, not me. Alipay is a third-party online payment system, as you guys know. No transaction fees, operated by part of the Alibaba Group. In 2016, this company closed the world's largest private fundraising for an internet company at about $4.5 billion, indicating a valuation of about $60 billion. So what's so special about Alipay? Next slide. Okay. Thank you, Azran. It was launched in 2004 as an online payment and escrow services. Alipay at first appeared as China's equivalent of PayPal. But the latest version of the Alipay mobile app has proven once more that it has grown from being just a payment app to a one-stop portal of payment solutions. So Alipay is a fully integrated and user-centric solution that covers a great variety of payment needs in people's daily life, all of this in one app. Users can transfer money to other Alipay members, share or split bills among them using the QR codes. So you can pay utility bills, top up mobile phone, credit cards, etc. So as if they were not already a threat to us, the banks, they also offer customers higher yield returns on their idle cash through their money market funds at actually higher rates than banks. The fund raised $90 billion in asset less than a year with 80 million customers. So these are examples, some of the key services of Alipay platform. But unlike most players who typically service only a portion of the transaction value chain, Alipay has developed itself into an integrated value chain and integrates to everyday life of all the customers, of their customers. And they give a much more holistic customer experience. So with one of the largest customer base in the world for an e-payment service provider, Alipay seems to be on an unstoppable trajectory to disrupt personal and transaction banking, especially in China. So it's apparent today we must anticipate and understand what the bank of the future could potentially look like. So how do we prepare for what's to come? Oh, they're not on top. Okay, thank you. Okay, so in the future, we will see customers even more entrenched on doing things online. There will be further developments and people will engage with information using all of their senses: touch, sight, sound, smell, and even taste. So Internet of Things will start to shape and transform how banking is conducted, migrating users beyond mobiles to wearables. So banks today are at a crossroads. More than ever, we need to reinvent ourselves. So what can a traditional bank do to overcome and prepare for these imminent changes? Firstly, we need to embrace technology to provide new relevant solutions to facilitate the changing needs of our customers. This delivered with superior customer experience together with a seamless interface will definitely attract new age customers. Further, with technology, banks will also be able to reduce costs and ultimately pass the savings to the customers. In addition, for banks to innovate and embrace technology, there is a need for banks to move away from the current operating model, the current technology operating model, and move towards agile development and open source systems. This involves exposing our APIs to the public to easily integrate and make available its products and services. It's also important that we explore and establish partnerships. With partnerships, banks will stand to gain from access to larger captive customer base and are able to further supplement its existing data with the partner's data to gain much more insights, much deeper insights into the consumer. For example, in a partnership with Telco, we will be able to gather critical customer data, which will give us insights on which websites the customer visits, thus providing us on the customer's lifestyle choices, where the customers travel, how often they travel there, and other relevant information on the customer so that we can target our offerings to the customer. We will also be able to achieve more business with integrated loyalty offers through our partners and lower the overall cost to acquire new customers. Banks are now investing heavily on data analytics and both marketing and risk. This is for both marketing and risk management. This will improve our acquisition as well as our portfolio credit quality. Big data, machine learning, and artificial intelligence are all new technologies which are where the battle is to succeed lies, and it will be the key differentiator on who will win the battle. For CIMB in particular, we have been very much cognizant of this new era of banking. So let me run through quickly what CIMB has been doing to stay ahead of the digital banking curve. In terms of product capabilities, we are constantly enhancing our online banking tool, CIMB Clicks, by improving system stability, for example, to reduce downtime, enabling quicker speed to market for new products, all at a lower operating cost. We also invested in mobile app that allows us to make payment, allows users to make payments for both in-store and online by leveraging on NFC technology. So all NFC-compatible Android smartphones will also be able to make payments by tapping on NFC terminals. Finally, by using the automated AI support, our customers will be able to chat with the bank via instant messaging, and they will be able to, among others, receive deals, promotion, pay bills, top up prepaid cards, and make even peer-to-peer payments. Internally, we have developed an integrated customer-facing channel, which provides the customers with one view of all the interactions and products the customers have with us. Additionally, using analytics and advanced data, our frontliners are provided with tailored products to sell to each individual customer. So this increases the productivity of the frontliners, thus saving our resources and reducing costs for the bank, and not also wasting time, the customer's time on something she or he does not want. I mentioned just now, this data can also be used for risk management. For example, based on the lifestyle and the risk profile, we can evaluate whether we should extend a particular loan to a customer. Of course, in Malaysia, these methods of credit evaluation are not common yet, but it's quite common now in other markets. As I mentioned earlier, we also need to reevaluate our current physical touchpoints. Today, CIMB has over 1,000 full-fledged branches across the region. Moving forward, we need to find a balance of being physically accessible and also providing the right amount of service and support with the most cost-efficient spend. As you know, customers are moving away from branches. We need to consider a different approach, consider probably a multi-branch model, the smaller dedicated sub-branches to support identified flagship branches. In the long term, who knows? We had someone who came to talk to our team recently called Brad King. He's the author of Bank 2.0. In his book, he said, my kids may never actually need to physically enter a branch by the time they are in college or in the workforce. Now that prediction is very much real. So in terms of operations, even for operations, we must digitize the operating processes to allow more automation, which is ultimately faster, more accurate, and less error-prone, and available, again, at a lower cost to the bank. So the end result is a holistic and consistent digital multi-channel and multi-product sales experience, which in particular, we have expanded aggressively across our markets in Malaysia, Indonesia, Singapore, and Thailand. Before I end, let me leave you with some key factors to consider as we embark on this technology journey in the financial sector. A financial institution today is governed under very strict rules to ensure the stability of the financial system and to ensure consumer protection. So not only banks need to change, regulations also need to keep up with customer demands for digital adoptions. We see regulators starting to be more receptive to drive digital adoption and are encouraging banks to move quicker in this space. As you know, last week, our central bank, Bank Negara, announced the establishment of a financial technology enabler group, FTEG, which will be responsible for formulating and enhancing regulatory policies to facilitate the adoption of technological innovation in the Malaysian financial industry. So we do applaud central bank's move to address consumer protection and market conduct, as well as possible impact on the orderly function of the financial system. Looking ahead, I believe it's no longer an option for anyone, for the banks, not to embrace technology holistically and completely. So I just leave you with a quote here by Stuart Brand. Once a new technology rolls over you, if you are not part of the steamroller, you are part of the road. So thank you very much, ladies and gentlemen.